Hey everyone, my name is Hoda Mehr. I'm founder and CEO of Starcard, and today we want to talk about Celsius, ticker CELH. This stock is owned by billionaires. At least two billionaires are owners of the company, and a lot of the folks in the Starcard community have been asking about this stock specifically to know whether it is a good candidate for our 100 bagger portfolio. This stock has done fabulously in the stock market. It has returned 31 times since it IPO'd in 2007. And the company's stock has been doing quite well in the 5-year period, in 1-year period, in 3 months period. So it's interesting to get into the detail and see whether, just like those billionaires, we should also be the owners of a stock. As usual, we'll use our 7-part 100 bagger stock analysis framework, evaluating the company's size, growth rate in revenue, earnings power growth rate, free cash flow, current valuation, quality of the leadership team and the insiders who own the stock, and lastly, the company's competitive moat in order to evaluate whether it has a spot in our 100 bagger portfolio or not. So let's get started with the first point, which is the company's size. As of now that I'm recording this analysis, the stock has a market cap of $7.5 billion. That means if we want to generate 100 times return, it needs to become a $750 billion company. Is that possible or not? It really depends on what we think the opportunity and the market potential is in this functional beverages and healthy beverages market. But I do like to make a comparison. A lot of companies in this industry basically aspire to become something like Monster Beverage. Monster Beverage, it's basically the king in the town when it comes to functional beverage, energy drinks, and things like that. So let's look at Monster Beverage market cap and see whether if Celsius can grow as big as Monster Beverage, does it have enough capacity in the market? It doesn't have enough market cap to grow. So Monster Beverage market cap, it's only a $51 billion company. So it is a very different number compared to $750 billion target that we just talked about for 100x return for Celsius. But let's just stretch our imaginations a little bit more and say Celsius become this big beverage company, owns multiple distributions, and it becomes something as big as Coca-Cola, ticker KO, or maybe Pepsi. You could even look at Pepsi. So I'm pulling up Coca-Cola as a stock card to see what is the market cap for Coca-Cola. And if you compare Celsius with Coca-Cola, whether there is enough growth rate in terms of market cap for Celsius. So Coca-Cola's market cap in its all glory, it's $262 billion in market cap. So from $7.5 billion, if it grows to become as big as Coca-Cola, it's going to be a $262 billion company. So basically right off the bat, what we learn right now is that for Celsius to become a 100x return, it doesn't look like there is enough market cap, addressable market capitalization out there in the beverage industry for Celsius to become a 100 bagger stock. That doesn't mean the company is a bad stock to own, and we'll go through some of this financial result, but definitely won't be a 100 bagger from where it is right now. So let's look at revenue growth rate, profitability, free cash flow, and valuation in the next few seconds to figure out whether the stock is it's a good company to own, or is a good stock to own or not. Under the financial strength section of the company's stock card, we typically pull all the financial information that we require in order to answer those questions. It's no surprise the company has been growing rapidly. Based on 6 different analysis, the stock has really a strong and growing revenue. Let's dig a little bit further. It is generating, in the last quarter, it generated $188 million in revenue and quarterly revenue growth of 22%. And annual revenue growth of 140%. Even if you look at it on a 3-year revenue growth rate, it's growing at 104%. Compare that to peers, it's comparable companies that are growing at 10%. So CELH Beverage, from a revenue growth point of view, it's a monster, pun intended. It's growing rapidly in a monstrous speed. So that's a really, really good sign. But let's see if the growth actually translates into profitability. We see in the profit section that based on 22 different analysis, the company is struggling with profitability. I'm not surprised. This is a small company. It's still trying to find its way, its distribution network. And for that reason, the stock is not yet profitable, but we have negative negative net income of 181 million. So they make about 188 million in quarterly revenue, and then they basically lose the same amount of money in net income, which means the company is extremely unprofitable at this point. Again, it's not surprised. What is actually surprising is that 2 fiscal quarters ago, they had positive quarterly EBITDA, and then now they became negative quarterly EBITDA. So it's an unstable profitability status, to say the least. Profit is not there. Obviously, for 100x, 100 return, those stocks that become 100 times in terms of return, they need to generate profit, and they need to translate that profit to return for their shareholders. Because the company is not profitable, I'm not going to spend any time on ROE, return for shareholders, or return on equity, but I do want to jump into the free cash flow. So it looks like the company's free cash flow status is not as bad as its profitability, generating some free cash flow, or maybe it's improving the status of its free cash flow. It is a free cash flow positive company with 127 million in last quarter, 31 million 2 fiscal quarter ago. And basically, if you look at the free cash flow growth rate, it was really downward in 3-year and year-over-year, but on a quarterly basis, it's grown. So it is getting there in terms of generating free cash flow, which is great news, because it means that the company business model is actually able to generate cash so that it can reinvest that cash into its operation, but it still is not as stable as we want to see. The other financial information that we want to look at in order to evaluate CELH fitness for our 100-bagger portfolio is that whether the company stock can be bought at a good valuation at this point, because it could be a very rapidly growing company, but if we can get a chance to buy it at a good valuation, we might be able to score a win there. So let's look at the valuation metrics for CELH. The typical things like price to earnings ratio, price to sales ratio, those are good indicators. The company's latest price to earnings ratio is basically 0 because it doesn't have any earnings. So that's obviously no surprise. And when we look at something like a price to sales ratio for the company, which basically is an indicator of how fast and how much the financial analysts and the broader Wall Street expect the revenue for this company to grow, how much of growth they're in terms of sales they're pricing into the stock. And it sounds like they expect the company to grow its sales at least by 13 times. So it is not a cheap stock by no means, not profitable. The price to sales ratio, which is a good indicator or good metric for evaluating valuation of companies at growth stage like this, is 13x. That's extremely expensive. And if you compare that to its peers, who are probably more mature companies, they are priced at 3.5. And so it's a really, really big gap between what you would be able to buy CELH at this point versus what would you pay for its peers. So let's go back to our framework and quickly review what we've learned so far about CELH financial information. We've learned that the company, in order to generate 100x return, it needs to become a $750 billion in market cap. But if you compare that to Monster Beverage or even Coca-Cola, it sounds like the 750 is not possible. The company's revenue is growing rapidly, above 100% growth, and it is much faster than peers and its industry. It doesn't have any stable profitability or EBITDA. It changes between quarters, and it does generate some free cash flow in the latest quarterly earning, but it's a unstable free cash flow. Some quarters is positive, some quarters is not positive, and at price to sales ratio of 13.4, 13.7x. This is a very expensive stock, even with a growth story mindset that we have for this stock. We have two more criteria in order to evaluate how well this stock and this company is and whether it has a spot in our portfolio. One, we want to talk about the leadership team, and then the other one talk about the competitive advantage of the company. And so this is where those billionaires comes in. Typically, you do want to invest in companies that have really high insider ownership, because it is good for the insiders to improve their value of their stake in the company, and with the consequence of that is that their incentives and your incentives are aligned. So high insider ownership is a really good sign, and it was very interesting for me to look at the company's proxy statement. And in this proxy statement, you can get a sense of company's ownership. In proxy statements that every company filed with the SEC, you can get who owns the company and what by what percentage. So this company CEO is not the original founder of the company. John Feroldi, who is the current CEO, has about 2% of the company. That's by itself, it's good for someone who is not the founder of the company, having almost 2% of the company. It's a good sign from an insider ownership point of view. But let's talk about the billionaires. So Carl DeSantis is part of the DeSantis family. He owns almost 25% of the company. And Li Ka-shing, who is a Chinese billionaire, 31st most or the richest person in the world, has almost 9% of the company. There is actually a study that companies that are owned by billionaires tend to do pretty well, just because of that analysis that I just shared with you. Your incentives and their incentives are aligned. They want to improve their wealth, but as a consequence of that, your wealth increases as a shareholder of the company that owns by billionaires. It's a very interesting study that actually there's an index that tracks the performance of the companies that are owned by billionaires and their families, and the index always overperform the broader S&P 500 market as far as the last time I looked at it. So these are the two billionaires that own the company. Li Ka-shing, as I said, 31st richest man on earth, and Carl DeSantis, part of the DeSantis family. They're also billionaires, and for that we would give the company a really big thumbs up, just because the historical evidence tells us that companies that are owned by billionaires tend to do really well in the market. So that's a thumbs up. And last part is the competitive advantage. And I gave a big thumbs up to Celsius for its competitive advantage. If anything, its competitive advantage and moat is increasing as it grows. The evidence of that is that Pepsi recently invested in the company and opened up its distribution network to the company. And for consumer goods and beverages company like Celsius, distribution is almost everything. If you can get your product in front of the customers in grocery stores and convenience stores and in drugstores and pharmacies and things like that, that's how you basically establish a brand, how customers get to buy you and get to see you on the shelves. And it's a very important moat for consumer packaged good products. So definitely they have that Pepsi investment and that distribution. They have great momentum, and gradually they're building a really strong brand known for their healthy energy drinks or healthy drinks. A lot of athletes are drinking it, and definitely a good direction for establishing momentum. So there you have it. These are the 7 criteria in order to evaluate whether Celsius can become a 100-bagger. From a 100-bagger point of view, I have to say, due to its current size, on a stable profitability, it's probably not going to be a 100 bagger, but certainly it can become it is already a very good stock, and it could be a very good hold in your portfolio. Where this 100x return could come from, let's just think about whether it's possible or not. Valuation is always a derivative of two things: the company's sales growth that results into growing everything else, profitability, free cash flow, and things like that, or how the market perceives the company and what kind of valuation the market associates to that stock. So from sales growth point of view, we saw the company is growing at almost 100x, 90x, or even more than 100x in the last year. And the market is expected to grow about 10%. So it is growing much, much faster than the market. If it can keep it up, that's definitely a good sign. The current valuation, though, let's take a look at it. If the company keep its 98% growth per year, or 100x growth in the market, if the company manages to grow at 25% per year, it would take it 21 years, more than 2 decades, in order to grow to that $750 billion in market cap. So we don't expect the company to grow 100% every year, but we're assuming 25% growth rate. And in order for it to reach that 100 times return for us, it needs to continue to grow at 25% pace for 21 years. So that's basically that's how the company can get to that 100x return. Most likely the valuation, the price to sales ratio, is actually going to come down because the company's sales growth is probably going to slow down from that 100% to maybe 50%, maybe 25%. That's a more feasible or logical assumption about the company's growth rate. But anyways, that's how the company can grow to become a 100x return. What would I look for in order to sort of track and monitor CELH in the coming quarters? We want to see the company to generate a stable profit. So that sales growth, that revenue growth, as it slows down, because the company is going to grow in terms of its coverage of the market, we want to see that it basically turns that sales growth into profit and stable free cash flow. That's one thing to monitor if you hold the stock or if you want to buy it right now. And then we certainly want to look at the company once again if the valuation drops, if something happens in the market, or maybe they have a few bad quarters, and they, as we know, the market tends to overreact to bad news in a lot of cases. So if something happens and the valuation drops, this is definitely would be an interesting one to take a look at. I don't own any shares of CELH. I don't believe it becomes a 100 bagger stock anytime soon, but I will be certainly monitoring this stock and maybe adding when I can get a chance to buy it at a better valuation. Before we wrap up, I want to share a very good news with you about a Starcard. The Starcard is a finalist on Benzinga's annual FinTech Award in the Best Research Technology category. We're so excited about this nomination and being a finalist. It basically explains and tells the world how our platform provides digestible insights to retail investors like you and I, and people in the industry are recognizing our superior product. And the results going to come in December 8th. Hopefully we will be the top dog of the bunch, even if we don't get, but hopefully we get there. We're very happy about this nomination. And as a follow-up to that, we are running a fundraising on republic.com/Starcard, and you now have a chance to join us not only as a user, but also as an investor and be a part of our 100 bagger story. We're building the future of retail investing, and we really hope you to join us as an investor, just like as you are a user and follower of our content. With that, please don't forget to like and subscribe this show, this episode, if you enjoyed it and if you found it informative. That's how the YouTube algorithm knows that our content is valuable and allows us to spread the word of intelligent investing to more retail investors out there. Thank you very much for watching. I'll see you in the next episode. Bye.